So far, we've looked at microeconomics, and we've seen how the price of different goods and services gets determined in the marketplace and the effect that that has on the way in which resources are allocated. We've thought about how efficient the market system is, and we've seen some of the problems. Now, there's one big issue left about how effective the market is for allocating scarce resources, and that is the issue of whether markets produce periods of high unemployment over time, and what's the role of the government in dealing with this problem. So now, to look at this, we're going to move away from microeconomics and think about the way the economy functions at the macro level. What determines not the extent of employment for plumbers, but the extent of employment for people in the economy generally. Not what determines the price of a bottle of wine, but what determines the price level. In other words, what causes inflation in the economy. So these are the big issues that we'll be looking at over the next few lectures. Now, in order to begin to understand these things, there's something we need to be clear about at the start. The vast majority of economists are agreed about the way in which markets allocate scarce resources. The vast majority of economists think that the market system is a very powerful mechanism for doing this. And the vast majority of economists see problems in using markets, the kind of things that we've looked at, externalities and so on. But when it comes to the big issue of government control of the economy at the macro level, how does the government react to the problem of unemployment and inflation and so on? Economists are less agreed. And in particular, there are two groups that we'll be looking at. There are economists called Keynesian economists and economists called classical economists, who have different views about these things. Each makes certain assumptions about the way in which the economy functions and then reasons through to a conclusion about the appropriate economic policies to be used. And so we'll need to look at these two groups, see how they think, and see why they come to different conclusions about government policy. But we're going to discover that a good starting point for these issues is to think about the amount of output that an economy produces in a given period of time, usually a year. We're going to do that, and so for this lecture, there's nothing controversial about what we're going to say. All economists are agreed about these issues, but they're crucial for understanding the background that will enable us to see why economists differ about the control of inflation and unemployment. So the starting point is going to be understanding what we call the national income accounts. Now, what we do is we look at any individual country and we say, how much output does this economy produce in the course of the year? How do we measure it? That's the national output. Then we're going to look again at the same issue by thinking about who gets the income earned in producing the output. Then we're going to have a third look at the accounts by asking the question, who buys the output that gets produced? So we've got three national income tables to consider: national output, national income, and national expenditure. And we're going to see that if you look at the accounts, you discover that the amount of output is identically equal to the amount of income earned, is identically equal to the amount of expenditure. That's what we're going to try to understand. And a good starting point for doing that is to look at what we call the circular flow of income. And the circular flow of income is a simplified picture, really, of how the economy functions. And at its very simplest, we'll make it a little bit more complicated in the next lecture, but at its very simplest, it looks something like this. Here we are with a picture of the economy in which we can see the relationship between national income, national output, and national expenditure, the circular flow of income. Here we have all the households in the economy. Remember, we're at a macro level here, so we're not just interested in the behaviour of one household now, we're interested in the behaviour of households as a whole. And there's a link between households and firms. So this is all the firms in the economy producing a great variety of different kinds of goods and services. And we're interested to look at the relationship between households and firms. And we discover that there are two important relationships. The first relationship is that households supply firms with what we could call factor services. That is mainly labour. They work for firms. You get a job and you offer your services to the firm in the form of labour services. But it's not just labour services. You might supply them with land that you own, or you might supply them with some funds in order for them to buy machinery and so on. So this is the provision of services, labour, etc., that we could call, if you like, national effort. Now, why are you willing to do that? Because in return for the provision of your efforts, firms supply these households with income. They pay for the labour that you supply. You get a job working in a factory one day a week, and in return for supplying your labour, the firms supply you with some income. So if we look at all of the income that is paid out by firms to households, that total is national income. But that's not the only link between households and firms. What do households do with the income that they've earned in providing the services of labour, etc., to firms? And the answer is they spend it. They buy goods and services. So we have here the national expenditure, where the national expenditure is the purchase of goods and services by households from firms. And in return for buying goods and services from firms, firms supply households with the goods themselves. So this is the national output that firms supply to households in return for the expenditure by firms. So we've got this two-way link, this circular flow of income. We supply to firms our factor services in return for some income. We take the income that we earn and we purchase goods and services from firms. So there's this flow of income that goes around. Now, what we want to do with the national income accounts is to measure that flow. And what we're going to do is to measure that flow at three different points. We're going to measure the flow of output of goods and services from firms to households, and we call that national output. How much is produced in the course of the year. We'll look at it as national income and ask, who gets the income earned in producing the output? And then we'll look at a third point on the flow and say, what's the national expenditure? Who's buying the output that firms produce? So when we look at the national income accounts now, we are looking at three different points in the flow of income, in the circular flow of income. And the first point in the circular flow that we're going to focus on is the national output. How much output gets produced in the course of the year? Now, when we look at the national output table, you would imagine that it's a very simple process. You simply take the value of the output that firms produce, and you say firms produce 1,000 bottles of wine in a year. They sell each bottle of wine for €3. That's €3,000 worth of output. If we add up all the output of all the firms during the course of the year, we've got national output. It's very straightforward and very simple, isn't it? Well, no, it isn't. It's a little bit more complicated than that. So we're going to produce now a national output table, and we'll certainly be simplifying, but we've got to do a little bit better than what I've just suggested. Now, why can't we do what I've just suggested? Take the number of units of output produced by firms and multiply by the price. Well, the first problem and the first reason we can't do that is that if we were to do that, we would very much overstate the amount of output that firms actually produce. We would have a problem that we sometimes refer to as double counting. And the easiest way of seeing the problem is to take a simplified economy, and with our simplified economy, look at the amount of output that is produced by that economy in the course of the year. In my little economy, we have 3 industries, and this is the amount of output that's produced. We have farmers producing wheat, and they produce €10 worth of output. We have millers producing €25 worth of flours, and we have bakers producing €55 worth of bread. So we might think that we can simply add up the output of farmers, €10, the output of millers, €25, the output of bakers, 55, and that gives us 55, 80, €90 worth of output. And if we did that, we'd be completely wrong. We'd be wrong because these millers are producing €25 worth of flour, but €10 worth of that output they haven't really produced at all. They've bought wheat and taken the €10 worth of wheat output and turned it into €25 worth of flour. So what they've done is to add value to the amount of output produced by farmers. Farmers started with nothing and turned it into €10 worth of output. The miller's €25 worth of output is the €10 worth of farmers' output of wheat plus €15 worth of value added. Similarly, if we look at the bakers, where did this €55 worth of output come from? It came from buying €25 worth of flour and turning it into €55 worth of output. In other words, they have added value, and they've added value by adding €30 worth of output to the €25 worth of output that was produced by the millers. Now, if we assume that this is all the output that is produced in the economy during the course of the year, what's the total value of output produced by the economy? And there are 2 ways of measuring it. One way of stopping this double counting procedure is to say, let's just write down in the national accounts, production of bread, €55 worth of output. And we'll get the right answer by doing that, in that we're ignoring the output produced by the what we call intermediate industries, the farmers and the millers, who are not selling to final consumers, they're selling to other industries. The total amount of output in the economy produced during the course of the year is really €55 worth of bread. That's what consumers are able to buy. There's an alternative way of arriving at the same answer. And that's to say, let's actually show the contribution of all the industries, in my case farming, milling and bakers, and do it by a value added method. And so we write down value added by farming, 10 euros, value added by milling, 15 euros, value added by bakers, 30 euros, and sum the values added. 10 plus 15 plus 30 comes to 55. It's the same output as if we ignored the contribution from intermediate industries and simply looked at the final contribution of these final industries. So we can either do it by taking only the contribution of firms selling to consumers and taking all the output they produce, or we can do it by looking at the values added of each individual sector of the economy. All the national income accounts that I've seen use the value added method. And although either will give us the right answer, the reason we use value added is that you get much more information. You can immediately see the contribution to national output made by all industries. If we do it by the final output method, it would appear that many industries, which are very significant for an economy, steel and so on, seem to do nothing because they only supply output to other industries. So now we've got a way of looking at the national output. We sum the values added by all industries to give us the total. There's another problem, and that is we can do this where there's a market. So you go into the shops and you buy the bread, and the farmers sold at a price the flour. The millers sold at a price to the bakers. There's a market, so we know the value of the output. What do we do when we have output that isn't sold through a market? What do we do with the value of policemen's services? There isn't a market in policemen. So where we have output not sold through a market, we have to make an assumption. And the assumption we make is that the value of the output produced is reflected in the cost of providing the service. So when the teacher is paid €1,000 a month for providing her services, which she doesn't sell in a market, it's the state that buys her services. The assumption is there's €1,000 worth of output of teaching services that's provided. And you may think that actually the teacher services are worth more than that or less than that, but it's an assumption we have to make in order to get the total value of the output of the economy. So now we're in a position to look at a very simplified national output table. So here we are looking at our national output table, highly simplified. We're looking at value added in different sectors: agriculture, manufacturing, and not just physical things, services as well. Haircuts are part of the national output. We look at the value added in all kinds of services, both the private sector and the state sector. And when we've added it all up, we get a sum that we call gross domestic product, GDP. So the GDP, the gross domestic product, is the value of the output produced within the borders of the economy during a given year. We haven't quite finished. There's something else that we need to take into account, and that is that actually there is some output which is really our output, which is produced outside of the economy. For example, if we take the UK, Britain owns investment in other countries. BP owns oil rigs that are in Alaska. And that oil that is produced there is partly UK output because it's produced with UK resources. It's really British output. And we know how much that output is worth because during the course of the year we receive income in the form of profits and dividends and interest on these investments overseas. So we want to add in the value of this output, even though it's produced somewhere else. But there's another problem. Some of UK output isn't really for British people because some resources, some capital, is owned by foreigners. In the UK, there are Japanese car firms who have invested capital in the UK so that part of the output from these Japanese car firms is really Japanese. And we know how much it is because there's an outflow of profits, dividends and interest on these industries and other industries which go out of the country back to Japan and other countries. So to take into account that, we have an item called property income from abroad, which is the net flow of inflow of profits, dividends and interest minus the outflow. Now for Britain, we have far more assets overseas than foreigners have in our country. So this net flow is positive. We have more inflow of profits, dividends and interest than outflow. So we'll want to add in the property income from abroad, and we can now go back to our table and do that very simply. If we add that property income from abroad, NPIA, net property income from abroad, then we will have the gross national product, GNP, the value of the output of the economy during the course of the year. Just to finish off the table, there's one more thing that we might want to do, and that's this. Gross is the term we use because we haven't taken into account the wear and tear on machinery in producing this output during the course of the year. And this is going to have to be replaced. The capital stock is wearing out. So we might want to make an allowance for what we call depreciation of the capital stock of all these industries. And if we subtract the value of this worn out capital, we will have the net national product. So the last item in the table is to take the gross national product and, if we think it's appropriate for our purposes, subtract capital consumption, depreciation, and GNP minus depreciation of capital gives us NNP, net national product. So that's the first table. We measured the circular flow of income at one point, the value of the output produced by firms. Now we want to look at a second table, and that is the national income table. And when we look at the income table, the question we're asking is, who gets the income from the production of this output? Who receives the income which enables them to buy output? That's what we're looking at in the national income table. And we're going to see that when we do that, the value of the national income is identical to the value of the output, because the question we're asking is, who receives the income in producing the output? So if we think, for example, about pensioners. Pensioners receive an income from the state during the course of the year to help them to live. But it's not an income earned in producing output. So we don't count the income of pensioners in the national income accounts. We're only interested at this point in income earned in producing output. And by doing that, we can make sure that national income is identical to national product. So what are the items which appear in the national income table? Let's have a look and see again a very simplified national income table. Well, when we look at the national income table, we discover that easily the biggest item is the earnings of labour. People work for it. So the item is usually technically referred to as compensation of employees, but it's essentially wages and salaries. And typically wages and salaries will amount to something of the order of 60 to 70% of all income earned in the production of output. But it's not just wages and salaries. There are other factor incomes. There's rental incomes. People own land, etc., which they rent out and get some income. It might only amount to 5 to 10% of national income, but it's a significant income. Then we have profits. Companies make profits, and that's an income that they receive from using these factors of production of capital. So that might include an item here of maybe 10 to 15% of the national income. In some countries, we have the profits from nationalised industries, the surpluses of nationalised industries. In the UK, this amounts to virtually zero because the only things which are in state hands don't tend to make any profits. But for some countries, that would be significant. And then the other one we would have is income from self-employed. People don't just earn wages and salaries, but you may have your own business, so self-employed incomes may be quite important. And that might add another 10% to the size of the national income. If we add all that lot up, we will have what we call the gross domestic income of the economy. Now, of course, that's domestic income, and as we'll see in a moment, gross domestic income is exactly the same amount as the gross domestic product. If we wish to look at the national income, then we'll have to add in the net property income from abroad, so that the gross national income is the same as the gross national output. And finally, if we want income net of wear and tear on machinery, net of depreciation, we subtract capital consumption, and that will give us net national income, which equals net national product. I hope it's clear then that these are national income identities, that the income has to equal the value of the output. It's important to understand that. So let's just take a simple example so that you can see why this is the case. During the course of the year, some firm produces a car. And the car is sold for, let's say, 1,000 euros. What do we write down as the national product, or the contribution to the national product of this car? We do not write down 1,000 euros, remember. We write down the value added. So actually, although this car is sold for 1,000 euros, this car firm took in to produce the car rubber and steel from other intermediate industries, and we'll say that the inputs from other industries came to 600 euros. So the national output table shows value added by the car industry as being only 400 euros. So the firm got 1,000 euros for selling the car and spent 600 euros buying inputs from other industries. What did it do with the 400 euros that it had left? And the answer is, it bought labour. Somebody worked to produce the car. It paid something to the owner of the land in the form of rental income. It hoped to have something left over for profits and so on. All of this 400 euros must be somebody's factor income. So we wrote down in the national product table, value added in the car, 400 euros. We wrote down in the national income table the labour, services, the profits and so on, the factor incomes of 400 euros. National income is identically equal to national product. And it's like that because we defined it as being like it. We've ignored pensioners' incomes. What we actually did was to write down the income to, let's say, labour before the deduction of tax, gross salaries, because the guy worked for the car firm and produced 50 euros worth of services that went down into the national product table as 50 euros worth of output. So in the national income table, that's 50 euros worth of national income. Actually, the government took some of that away from him in tax and used some of that and redistributed to pensioners. But for national income purposes, we took the sum gross of tax and ignored the transfer payment to pensioners so that we only looked at income earned in producing output. And by doing that, national income is identically equal to national product. So that's 2 out of 3, we've got 1 left. We're now going to think about the national expenditure table and ask the question, who buys the output that is being produced? And you've already guessed, we're going to find that national expenditure is exactly the same as national product, because what we're going to do is only take into account that expenditure which is the purchase of the national product. Any expenditure which is not buying the national product, we won't take into account. But any output that is produced, we're going to ask the question, who bought it? So now we turn finally to the national expenditure table, which is unfortunately slightly more complicated than the other 2, but is going to be hugely useful for us in understanding the way in which the economy functions. So now let's turn to our national expenditure table. Who buys the output that gets produced in the course of the year? Well, there are a number of different groups. Let's write them down and see what the national expenditure table looks like. The biggest purchaser of this output is households. We might call it consumers' expenditure or household expenditure. So all those things that people buy by way of cars, travel, entertainment, food, clothing, etc., is households' expenditure, which is probably 60 or 70% of the value of the output that we produce. We'll call it consumption expenditure, C. But it's important to see that it's not only households that purchase this output. Some of this output is bought by other firms. Firms buy output for investment purposes. So one of the things which was produced by firms is a machine to help make a car or whatever it is. And it wasn't, the machine wasn't bought by households, it was bought by other firms. And all this is what we call investment. Not, as far as economists are concerned, the purchase of shares, but the purchase of man-made machinery and buildings and so on. That's what we understand to be investment. So we've got some of the output is bought by households, some of it is bought by firms, actually some of it by private firms, some of it is bought by the state. So if a new building is produced of a fire station, it won't be bought by a private sector firm, it'll be bought by the state. But it's still adding to the capital stock, it's still investment. Now there's another kind of investment that is going to be very important to us in helping us to understand the way in which the economy functions. This is the investment in the capital stock. But there's also an investment in stocks of goods. And this is very important that we understand what's going on here. During the course of the year, the car industry produced that car for €1,000, and we put into the national product table the value added, we said, of €400. In the national income table, we wrote down income earned in producing the car, and that came to €400 worth of income. So we want to write into the national expenditure table now the €400 worth of expenditure on that car. So we need to ask the question, who bought it? In a lot of cases, the answer will be some household. Somebody went to the showroom and bought the car. What are we going to do about the fact that the firm produced the car? It's in the national product table. They paid someone to make the car. It's in the income table. But nobody bought it. They hope to sell it, but nobody's bought it yet. And it's lying in a field, unsold. If expenditure is going to equal product, what are we going to do? So in order to make sure that the account balances, we're going to have to add in the stocks of the cars which have been built up, which are unsold. So one of the items in the table is the change in stocks. Now, it may be that that change in stocks was intended, that firms decided to increase stocks in case there's an unexpected rise in demand. It may well be that it was unintended. They expected to sell the car. Incomes were falling. There was a recession. They didn't sell the car, and there's an unintended stock change. But the change in stocks has to be part of the national expenditure table. And it's going to be very important that you see that when we look at how the economy functions in the next lecture. So let's come back to the table now. So we've got this item, the change in stocks is another item in the national expenditure table. So we've got, this is going to count as investment. Investment might be in capital, it might be in a stock change. The next item is government expenditure. Now, if the government expenditure is on capital items, we put it here in investment. But this is government expenditure on current produced goods and services. So this would include the health service, buying bandages that get used up when somebody comes in with an accident. It will include the purchase of the services of teachers and the purchase of the services of nurses and so on. So government expenditure on these services, the services were in national product table, the nurses earned an income, who bought their services, the government, that is government expenditure. So we've got C, I and G are items in national expenditure. But we still haven't finished. The next one, which may be a slight surprise to you, is exports. Some of the output that is produced during the course of the year is built by foreigners, and we'll use X to stand for exports. Now, you may be slightly surprised to discover that exports are in there in the sense that this item isn't bought by the British or the Bulgarians or whatever country it happens to be. These goods and services are sold overseas. But remember that what we're trying to do in the table is to ask who bought the output that's produced. So if the British make a car and sell it overseas, it's bought by a foreigner. It's British output. So these exports we have to include as part of expenditure by foreigners on British output. So exports are another item in the expenditure table. One more thing to think about, and that is imports. And imports will be a minus item. I can't write I for imports because I've used it for investment, so I'll write M for imports. And I'm going to, having added up C and I and G and X, I'm going to have to subtract imports. Why is that the case? Well, when we looked at the purchase of goods and services by households, part of it was your purchasing of, from your own country, of a car or a bottle of wine or whatever. But part of your expenditure was actually not expenditure on your own national output. Part of your expenditure was on French perfume or some other good which was imported from abroad. So if I don't do something about it, I've overstated the extent to which your consumption is on your own country's output. So in order to overcome that problem, to the extent that you've bought stuff from abroad, I need to subtract that item in order to get the value of expenditure equal to the value of output. So we've got the essence of the expenditure table: consumption expenditure, investment expenditure including stocks, government current expenditure, plus exports, minus imports. And I'd love to be able to tell you that if we look at that amount, it will exactly balance what we saw for income and for national output. Unfortunately, the sum that we come up with doesn't balance because we've got one more problem to take into account. And that's the problem of indirect taxes and subsidies. How do we explain the problem? Let's take one particular good as an illustration of the problem. During the course of the year, the cigarette companies manufactured some cigarettes, and we wrote down in the national product table the value added, and let's say we wrote down whatever was the value of this output. It came to €1. Somebody earned some income in producing that packet of cigarettes, so we wrote down in the national income table income earned by the guy who worked to produce the cigarettes, €1. So clearly, to make the account balance, we now need to write in the national expenditure account the packet of cigarettes bought by you, €1. But when you went to the shop, you didn't pay €1, you paid €4, because the government added an indirect tax of €3 in order to raise some revenue. So to the extent that we've written down as consumption item, consumption of the packet of cigarettes, €4, we've overstated the extent to which you are purchasing the national output. So to correct for that, I'm going to have to subtract that proportion of the packet of cigarettes, which is the indirect tax. So we're going to have to take indirect taxes and subtract that sum. And finally, there are a few products which are subsidized by the government. To that extent, when you purchase that good, you were actually not paying the full cost because the government subsidized it. And so the value of the output was greater than the value that you paid for it. So to the extent that some products are subsidized, I'm going to need to add that on. So what we've got now is C plus I plus G plus X minus M gives us what we call the gross national expenditure at market prices. But I'm now going to have to subtract the indirect taxes, add on the subsidies, and then we'll have the gross national expenditure at factor cost, as it's called, which will exactly match gross national income, which is exactly equal to gross national product. Simply to finish the table, if we want net national expenditure, then we'll have to subtract capital consumption. If we want gross domestic expenditure rather than gross national expenditure, we'll subtract the net property income from abroad and so on. But what we've now got is three sets of tables: income, product, expenditure. What gets produced, who earns it, who purchases it. There's just one last thing which I want to mention very briefly about these tables. We've done the most important bit, understanding how they're constructed. We're going to use the essence of this in order to understand how the economy functions. Some people are interested in the question, how good is the national product at reflecting consumers' welfare? As the value of output rises over time, is it true that our sense of well-being rises? What's the link between national output, national product, and welfare? There is a link, but it's not a perfect one. And I'm just quickly going to run through half a dozen of the main things to be aware of when we assume that an increase in the amount of output that an economy produces equals an increase in their welfare. What are the main ones? Here they are, a very quick, short list. First one is that over time, prices tend to rise. So when you look at the gross national product over time, it seems to be going up. But it may be going up not because we're producing more, but because we're producing the same amount at a higher set of prices. So in order to make comparisons over time, we'll need to net out the effect of inflation and look not at what we call money output, but real output. The output multiplied by a constant set of prices that takes care of inflation. Next, we'll have to be careful that we look at the national product per head of population. If next year national output rises by 10% and we've got 10% more people, output per head hasn't changed. So a more realistic idea is to look at product per head. So that's the second problem to take into account. There are other problems too that we might want to think about. It might be more realistic if instead of looking at gross national product, we look at net national product, because we have to replace the worn out capital stock. Does that enable us to be happy with the figure that we've got as a measure of welfare? No, there are still other problems. In producing this output, there are sometimes byproducts in the production process. More noise, more filth in the rivers, more air pollution and so on. All those problems that we looked at earlier with regard to externalities. So we may want to make some attempt to correct for these externalities to give us an idea of the real value of the output that we produce. Let's explain the problem like this with an example. In the national product table is the value added in a packet of cigarettes, €1. In the national income table is the income earned in producing that packet of cigarettes. So we want in the national expenditure table who bought the packet of cigarettes and show it as being €1. Here's the problem. You went to the shop, you bought that packet of cigarettes and you paid €4. You paid the €1 that it cost to manufacture plus €3 worth of indirect taxes. If I'm going to get the account to balance, I'll have to subtract the indirect tax you made so that you paid, so that the value of the expenditure equals the value of the product. Similarly, there's a problem because some things were subsidized. What you paid in the shop is less than the value of the resources consumed that we put into the national product table. So to make the expenditure table balance the income and output table, we'll have to subtract indirect taxes and add on the subsidies. When we do that, we've got product equaling income equaling expenditure. Gross national product equals gross national expenditure. Net national product equals net national expenditure. Domestic product equals domestic expenditure, and so on. We now have an identity that product equals income equals expenditure. Very briefly, there's one last issue that we might think about. We've done the main thing, but some people are interested in the extent to which these product tables reflect society's well-being. Can we say that if national output is rising, national well-being is rising? Well, to some extent, yes, but let's just very briefly list a series of problems in making that assumption. Firstly, if we're going to see the link between output and well-being, we ought to do it with net product to take into account the wear and tear on machinery. Second, we should take into account the extent to which, over time, output rises apparently simply because we have inflation. We need to look at real output, not, as we call it, money output. Thirdly, we should take into account the fact that we need to look at output per head. Yes, output might be rising, but if the size of the population is rising, output per person isn't necessarily rising. So we need to do all that. Next, we might want to think about the distribution of income. If wealth and income is concentrated into just a very small number of hands, we might not feel that it well reflects on the income and well-being of the nation at large. So we might want to think about how well income is distributed, as we did in a lecture before. Next, we might want to think about the extent to which, in producing this output, we produce harmful side effects, as we did in the lecture on externalities. Output might be rising, but we may have more noise, more mental stress, and so on. We might want to take that into account when we reflect upon welfare. Finally, when we think about comparing our well-being with other countries' well-being, there's a couple of other issues just to think through very briefly. One is, we may have the same income per head, but be working far longer for it. We don't pick up the value of leisure in the national income accounts. And so we might want to wonder whether we have as much welfare if we have the same output per head as another country, but we're working longer hours to achieve it? And finally, we might want to think about exchange rates. When we compare our own country with another country, we've got sometimes to use different exchange rates. The UK uses pounds, the Americans use dollars. When we make the comparison, we'll have to have some exchange rate to change pounds into dollars. The exchange rate varies over time. Do we feel that this adequately picks up and deals with the problem? So we've done a huge amount. The key that we've done is to understand that national product is equal to national income is equal to national expenditure. And in particular, when we look at national expenditure, we've looked at the problem of stock changes. These things, at the moment, you may think, is this so significant? But you have to understand these basic things because they're going to be vital for us in understanding the key policy issues of how governments control unemployment and inflation in the economy.